Friends, in today's video, we are going to talk about the Quant Small Cap Fund. The fund's performance has dropped sharply over the past year, ever since SEBI accused it of front-running and conducted raids on its offices in June 2024. As a result, the fund's investment strategy was badly disrupted, which negatively impacted performance, and it has still not recovered from the impact of that episode. That is why, over the past 1 year, while the category delivered a flat return of around 0.68%, this fund generated a negative return of more than 6%. However, if we look at the fund's long-term performances, then it has been outstanding. Over the 10-year time frame, which is considered long-term, the fund ranks number 2 in its category. Even in the 5-year time frame, despite the recent setback, the fund still holds the number 1 spot in terms of returns within the category. This is an established fund with a track record of more than 12 years. Throughout this period, it has consistently outperformed category averages, with the only exception being its performance in the last year. The fund enjoys very strong investor trust, which is clearly evident from its AUM. Even now, despite some investor redemptions, its AUM remains quite high at rupees 29,463 crores. So investors are facing confusion. On one hand, the fund had delivered excellent performance in the long term and even in the medium term. On the other hand, performance has slipped over the past year. In such a situation, should investor continue with the fund or exit? And should they take advantage of the lower NAV to start investing in the fund either through SIP or lump sum? In this video, we will try to find out answers of these questions. First, let us take a detailed look at this fund's return so you can better understand what kind of fund it is and how it has performed across different time frames. Over the 1 year period, the fund delivered negative returns of around 6%. In the 2 years, performance was in line with the category. It either underperformed nor outperformed. But if you look at the 3-year, 5-year and 10-year periods, the performance has been consistently strong compared to the category averages. In the 3-year time frame, the fund delivered returns of 26.99%, while the category delivered only 22.74%. This is a clear outperformance. However, the most exceptional results came in the midterm, as the fund rode the post-COVID recovery extremely well. Thanks to that, its 5-year returns stands at 37.27%. If not for the weaker performance over the past year, the 5-year returns would have been crossed 40%, which is an outstanding figure by any standard. Compounded returns at that level over 5 years can create tremendous growth for your investment. Looking at the 10-year long-term performance, where returns typically average out, the fund has still outperformed its category by a healthy margin. Over 10 years, it has delivered 20.36% compared to the category average of 17.97%. Within its category, it currently ranks number 2 in this time frame. In the 5-year time frame, it continues to hold the number 1 spot. So even after the sharp decline in performance over the past year, the fund still ranks second in its category for 10-year performance, showing its overall strength. Now let us talk about the fund's investment strategy. Earlier, the fund used to follow a very aggressive approach, and that is why it was able to generate excellent returns. But ever since its strategy was disrupted after SEBI's raid last year, the fund has become more defensive. To handle any potential redemption pressure, it has gone overweight in large caps. It has also started holding some very heavyweight stocks. For example, it has a 10% exposure in Reliance Industries. And as you know, Reliance performance has been quite poor for the last year or so. This has also negatively impacted the fund's returns. That said, the fund has gradually begun realigning its strategy with the market and is slowly shifting back towards its earlier aggressive style, aiming to generate stronger returns in the future. Evidence of this is that the fund is currently almost fully invested, that is 97.05% of its corpus in equities. This means that if the market rallies, the fund is positioned to capture the full upside because of its high equity allocation. The fund is also heavily diversified, in fact over-diversified compared to category. While the average number of holdings in a small cap fund is 87 for the category, this fund holds 106 stocks in its portfolio. The benefit of this is it lowers volatility and reduces risk. However, the Drawback is more moderate returns. To achieve very high returns, a concentrated portfolio is required. But this fund has diluted its concentration by spreading across so many holdings. Of course, part of this can be explained by the large AUM. For a small cap fund with such a high corpus, maintaining a concentrated portfolio becomes less feasible as the fund grows. So diversification is almost inevitable. Still, to balance out the dilution from over diversification, the fund has taken a more concentrated approach in the sectoral allocation. If an individual stock underperforms, it wouldn't drag down the fund. But if an entire sector performs well, the fund benefits immensely. We can see this clearly in numbers. The top three sectors account for 50.68% of the portfolio, compared to a category average of just 19.98%. That is more than 2.5 times higher concentration. So these top three sectors perform well, the fund can still deliver strong returns despite being over diversified at the stock level. The top three sectors is overweight in are financial, healthcare, and services. As mentioned, after the SEBI raid, the fund moved into a defensive stance. This is especially visible in its market cap allocation. The category average allocation to large cap in small cap fund category is only 5.31%, but this fund has invested 23.80% in large cap shares. That is about 15% more than average. Large caps add stability but not high returns, which also explains why this fund's 1 year performance has been weak. Also, fund has invested only 71.79% of its corpus in small caps, while the category average is about 79%. So it is about 7% underweight in small caps and 15% overweight in large caps. Naturally, this tilt dilutes its overall performance. When it comes to the risk ratios, they too have been negatively impacted due to weaker performance. For instance, funds beta is at 0.92 versus the category average of 0.83. This means the fund's NAV is more volatile than peers, which investors are already experiencing. If we discuss the Sharpe ratio, then fund Sharpe ratio is at 1.29 compared to the category average of 1.17. So it is better than category but not exceptionally strong. However, the most important measure which measures return of a fund against the benchmark is alpha, which is at 2.71 for this fund. That means if the small cap benchmark, that is Nifty Small Cap 250 TRI, delivers 10% returns, then this fund can generate about 12.71% returns, or an extra 2.71% returns above benchmark. By comparison, the category's average alpha is at 1.75. So this fund is generating roughly 1% more alpha than category. In short, the fund is generating 2.71% more than benchmark returns and about 1% more than the category average. However, one more negative factor in this fund is its expense ratio. While the category average is 0.64, this fund's expense ratio is 0.71, which doesn't work in its favor. So, in conclusion, the big question is, should you stay invested in this fund and is it the right time to start a fresh investment? This fund has been a very strong performer over the long term, and that is why many investors were waiting for its NAV to come down, so they could grab an entry opportunity at lower levels. Now, if you choose to invest at this point, it will basically be a contrarian call because the fund's performance over the past year hasn't been very strong. And if you look at the shorter term numbers, whether 1 month, 3 months or 6 months, there is not much improvement. Compared to the category average, the fund is mostly just matching the category averages or even slightly underperforming. So one option is you wait a bit more. Once there are clear signs of performance improvement, then you can start investing. But the other option is you take a contrarian view, that since the NAV is already down, this will be a great opportunity to invest at lower levels. In that case, you can start investing right now. So if you are planning a lump sum investment in this fund, please stagger your investment instead of putting all the money in at once. That way, you manage your risk better and still capture the opportunity.